Hello and welcome back to the Sustainability Talks podcast. I'm your host, Patrick Sheehan, Managing Partner at ETF Partners, Europe's leading venture capital firm focused on backing businesses that deliver what we call sustainability through innovation. In today's episode of Sustainability Talks, we're speaking with Jamie Arbib, the founder of Rethink X, an independent think tank and research organization that analyzes and forecasts the scope, speed, and scale of technology-driven disruption, as well as its implications across society. Now, the work of Rethink X is fundamentally transformational and uniquely speaks to how technology will be the critical enabler in solving many of the world's most pressing problems. It's a mission and purpose that we are closely aligned with at ETF Partners. So I'm delighted that we're discussing Jamie's own motivation for founding the company, his thoughts on why the world does need to change post-COP26, and in particular, his views of how it's likely to. Joining me for this conversation with Jamie is my co-host and ETF Partners Managing Partner, Rob Ganisa. My first question is, why on earth did you start a think tank? It's, most people follow football teams or things like that.
Well, thanks, Patrick. Yeah, I prefer the term research organization, but I guess think tank will do. That tends to be the box we get put in. Yeah, so I mean, it goes back a long way, as you know, and I've known you guys maybe 20 years now. I got involved in the environment movement and started investing in clean tech. Probably 20 years ago now.
Right, exactly.
And maybe 10 years ago, I started to get slightly frustrated with the kind of environmental narrative, the kind of doom and gloom that was in it. Because what I was seeing in the tech space was that, if you knew anything about cost curves, that cost curves of clean technologies were going to begin to outcompete fossil fuel technologies or incumbent businesses more generally, and there was an inevitability that there'd be disruption of major sectors of the economy coming into the 2020s. That actually, what would drive the adoption of clean technology was going to be economics. The fact that these technologies were cheaper and better, and not this kind of climate imperative necessarily. That was certainly a secondary factor and an important driver of government policy that's maybe accelerated those cost curves. But without the cost curves, we were kind of doomed. And I think, my feeling at the time was that, environmentalists were playing the climate card, but clean energy, for instance, had a whole bunch of other reasons or other cards that we could play. Everything from the economics to national security to resilience, to health and well-being and so on, that just weren't getting a look in. And in some ways, climate change and clean energy were becoming conflated, and that kind of polarized debate that was happening in America was kind of an outcome of that. And so anyway, long story short, I ended up getting invited by the US military to a scenario planning exercise. Must have been six, 7 years ago, out in Washington. And they invited 10 experts to come brief them. And they were exploring a scenario of a rapid energy transition. They're asking the question, what will it mean for geopolitics if we get off fossil fuels very quickly? And literally 8 of the 10 presentations were identical. They were kind of big oil company scenario teams. It was big consultancies, Department of Government, so on and so forth. The big international NGOs. You'll know the kind of characters. You'd have seen their work, and they all had these identical forecasts for the adoption of solar PV, the adoption of electric vehicles. These kind of low straight lines out into the future, out to 2050 even, of maybe 10-20% adoption by then. And I remember this guy called Tony Siebert getting up halfway through and saying, look, that's not how technology disruptions work. They're not these kind of slow incremental progressions. They're rapid, they're non-linear. It's an S-curve. Right. And these disruptions are over by the 2030s. And if you guys are going to, make your plans based on these faulty forecasts, you're going to make some horrible mistakes. And when it was my turn to speak, I got up and I basically said, look, I agree with Tony. And so Tony and I, ended up going for coffee afterwards, and we spoke for months afterwards about everything from education to food and agriculture to transport and energy, obviously, to healthcare. How a series of technologies, underlying technologies, we saw developing in such a way that every sector of the economy would be disrupted through the 2020s with profound impacts on society, and we were just blissfully unaware of it as a kind of broader society, whether we're investors or whether we're policymakers or whether we're entrepreneurs. And And we decided after months of talking that we had no choice really but to go out and build some analysis that actually captures the complexity of the system, the kind of the systems dynamics, of feedback loops that drive those S curves and drive that non-linearity. So Rethink X was the outcome of that. We're set up as a not-for-profit, and our mission literally is to provide better analysis so decision makers can take better decisions.
Gosh, there's so much I want to ask you already in that, but it sounds like it was born out of some frustration. And out of a frustration at the inability of people to think differently. Is that? But yet you and Tony then are saying actually thinking differently is quite simple. You just have to think about cost curves, right? So they're pretty much logarithmic straight lines. That's not very hard, is it? Why do people find that difficult?
I think cost curves and complexity. I think one of the issues that, in any complex system, whether you're thinking about the human body, or thinking about an ecosystem, a climate system, or a sector of the economy, most of the time we're in a kind of an equilibrium state where the system is stable. So think of the transport system or the energy system. They're the structure of the system, the infrastructure, the business model, the basis of the technology. They've all been the same for 100 years. Sure, they've grown massively, and technologies developed, but the systems essentially are the same. And so, in those equilibrium phases where, essentially, technically, kind of negative feedback loops are holding us, constraining change and holding us in that equilibrium, that kind of linear thinking is not a bad approximation for the future. You can kind of assume that the system holds and remains stable, 10, 20, 30 years out. And so that kind of linearity is not a bad thing. But when you come up to a period of change, and as I say, it's the same in any complex system, where the system falls out of equilibrium when these accelerating feedback loops kick on and drive change, and the S curve begins, it's a horrible approximation for the future. So, the answer really is it hasn't cost us historically, certainly the last 100 or so years, apart from some relatively minor disruptions in individual sectors. Well, we haven't seen a kind of system change on this scale across society for a long period of time.
So this, in other words, the imminent future is very different to the past as we've known it. Is that what you're saying?
Yeah, the future is not a continuation of the past. Yeah, so the way we see it, everything in the system essentially is a variable. What we tend to do when we're analyzing the future is assume that everything's a constant.
Right, and now I want to get into some examples to make it real. But before I do, maybe I can just, this might sound a bit rude actually, but who's listening to you? You started off the two of you because you're frustrated, but can you give us and help us all understand, where are you now? Are you preaching to the choir? Are you converting people? What's that?
Yeah, I don't think we have a choir, Patrick. It'd be nice to think we did have a choir that we could preach to. But no, we get a lot of interest in our work, certainly from investors. We get interest from governments. Tend to be the kind of up and coming governments. We've spent quite a bit of time with the Indian government. We've had interest in Israel and in a lot of other kind of parts of the developing world. We have spoken to a number of kind of Western governments. A lot of business and a slightly broader audience are just interested. People are interested in this kind of thing. But we've done a terrible job, and we're a bunch of research geeks essentially, and we publish 80-page reports, which there's not a hell of a market for these days. I struggle to read other people's 80-page reports, so it's a lot to expect. So we've actually just hired a new CEO from a communications background. And so, we obviously continue with the research and apply it to other sectors and other kind of domains of society. But really, the aim now is to tell our story better, to reach a broad audience.
And Jamie, maybe just to pick up on that, I think you have a very compelling story. You can demonstrate to people the power of breakthrough technologies, the actual cost curves of technology. But I know in those early days, you were frustrated that big money went back to these ideas. The pension funds, I think in particular, the insurance companies, they were relatively conservative. And something seems to have changed in that they're much more interested in your message than ever before. Maybe you could help us understand what's changing in regards to the availability of the money.
Honestly, I think the evidence is all around us. I think there's a sense that things are changing, at a macro level, at a kind of societal level, but also in the individual sectors of the economy. So, let's talk about kind of energy or transport to be a bit more specific. My co-founder, Tony Sieber, published a book or two books, one called Solar Trillions. Solar Trillions, not billion. I'd never even heard the term trillions in 2009 when he published it. and he published a book called The Clean Disruption in 2014, which kind of predate our work. And you know, what was interesting at the time was that, you know, he was almost laughed at. I mean, he had these forecasts for, you know, he forecast in Clean Disruption that by 2030, 100% of new vehicle sales would be electric, right? That the cost of an electric vehicle would be well below $10,000 by 2030, and people laughed at him, you know. And same with his solar forecast, right? He forecast by 2020 we'd have solar at less than 3 cents per kilowatt hour. You know, that target was reached, you know, 3 years before he anticipated. So he was conservative, and you know, the numbers we track for electric vehicles suggest he's conservative on electric vehicle numbers as well. We've seen, you know, sub $10,000 SUVs released in China that can do 200 miles, right? So the cost curves are kind of inevitable. People make kind of constant mistakes about these things, and we can come back to that, talk about some of the mistakes people make. But really, I think, you know, we're seeing in all these markets the beginning of kind of takeoff. So, you know, electric vehicles. Super interesting what's happened. I mean, we talked about the feedback loops that might drive disruption. One of them is investment, right? That investment floods from the old to the new. And so in the US so far this year, you've seen 85% of investment dollars going to electric and autonomous vehicles. That's a big accelerator. We're seeing the adoption of electric vehicles pick up. We now, globally last month, I think 17% of new vehicle sales were electric. Right? That's an extraordinary growth from where we were. And so I think people are finally realizing, you know, Christ, these guys knew something, right? I mean, Tony's been saying this for months. It's kind of tracking, because when you understand the cost curves, you can see, you know, as a cost comes down, it opens up new market opportunities, right? So electric vehicles is what we call a disruption from above. You start in the luxury vehicle market, and as the costs come down, you can compete in the mid market and then the low cost market. And so that's exactly what we're seeing. You can predict when those markets will begin to open up, and that's just what we're seeing today. And so, you know, I think people have, you know, finally realized that, you know, Christ, you know, the way we've been looking at things has not been helpful, and we've been blind to what's coming.
So Jamie, you said one of the problems is getting the message out, and you know, today you're talking to professional summarizers. That's our job as investors, and I think what you're saying is not only are cost curves very predictable, but we're now at or beyond the tipping points of some of the critical cost curves around clean energy and transportation. Yeah, is that a good summary?
No, I think that is, and you know, we're going to see in the material space, the food and material space, you know, right, that same process begin to happen in the next 2 or 3 years as we reach these kind of critical inflection points. No, that's absolutely right. I think we're getting to those points.
Okay, you're seeing a world where there's established, powerful cost curves reducing the cost of deploying solar and wind, and you know, to what degree is that just going to change everything?
Yeah, so solar, wind, and batteries, right? They're all on these incredible cost curves. I think, you know, I mean, batteries are down 90% in a decade, solar 80%, and we expect those cost curves to continue. You know, cost curves aren't on smooth lines. I mean, we'll have, you know, resource bottlenecks, you know, and so on that cause them to spike at certain points in that period, but the trend is set, and we expect those to follow. And so we're seeing different markets open up. So first of all, we saw, you know, the market for new build generation get disrupted. So most new build generation globally now is renewable, right? And that's a market that's already been disrupted. It's not a big part of the market because these assets last so long. But we're also now seeing the peaking market disrupted, right, as batteries come in and compete. And we're seeing a massive ramp up in batteries being installed in grids and the production of batteries. And then, you know, we're not far away from the point in certain parts of the world where solar, wind, and batteries begin to compete with the marginal cost of fossil fuel generation. Right. So when they basically begin to outcompete existing power plants, and then further down the line.
So when is that? Is that?
Well, it depends where you are in the world, but it's you know, in some parts of the world we're there already. But that's gonna happen over the course of this decade, essentially. But what's really interesting, and what people miss in the energy space, is first of all that, you know, disruption is not a substitution. So we're not talking here about a substitution of a gas or a coal-fired plant for a solar farm, right? This is a totally different architecture and a system with different properties. We call that a phase change. And so, you know, when you build a 100% solar, wind, and battery energy system, you know, you have to deal with the problem of intermittency, the sort of dark winter months in Europe that you have to provide enough power for. And you can do that in a couple of ways. You can either massively overbuild storage, or you can massively overbuild generation capacity. Either way is pretty expensive, but you get what's called, what we've called a U curve, where in the middle there's a sort of the lowest cost system,
right?
And that involves, given the solar cost curve at the moment, gives an overbuild of solar of somewhere 3 to 6x what we currently have to meet demand on the darkest day of winter. And that system has incredibly different dynamics to our current system, because for the rest of the year you get a superabundance of essentially free energy. And we see that as a problem today. We talk about curtailing it, but it's not. It's a huge opportunity. All kinds of industries will respond to that incentive of low-cost energy that's available, things where demand is shiftable. So, things like steel production, things like vertical farming, things like cryptocurrency mining or water desalination. There are all kinds of industrial and other uses that will respond to that. So it will disrupt industry after industry as well. So that's, that's one of the other things that people miss, is just the scale of difference.
Jamie, I can't resist being the tough guy and asking the obvious question. It all sounds good and very rational. But yet I think this past couple months we've had UK energy prices soar. Natural gas prices went through the roof, and the first thing a large portion of populists wanted, I think, and perhaps some of the politicians were supporting, was we have to roll back on some of these green initiatives, called them, right? So maybe that's an irrational response to your cost curves, but it's kind of real life. So how do you deal with that when you see people sort of pushing back on this?
Yeah, and we expect to see that, right? We'll expect that's a dynamic that will happen, and we expect to see fossil fuel energy subsidized through the course of the 2020s as an inevitability. Because one of the other dynamics that people miss is what happens to fossil fuel prices, right? So, what we've seen, and we identified this in one of our reports, is actually we've been miscalculating the cost of conventional power sources, because it's assumed in all the models of levelized cost of energy, which is a calculation that takes all the costs of building and running an energy system and divides it by the amount of power it produces. Well, there's an assumption in there that the utilization rate, what's called the capacity factor, is a constant, sort of 85%. You build a coal-fired power station today or a gas-fired power station, and it will run for 85% of its lifetime. Turns out that's a variable, which, of course it is. And as we've seen more renewable sources come on stream, these power plants operate less and less, and coal in the UK is down, well below 10%. It's about in the 30s in the US, and it's on a downward trajectory and will continue to decline. So the actual levelized cost of conventional power sources is far higher than we've been calculating. So as we get the continued decline of new sources, new technologies on the cost curve, we get the increase of the old, and the difference keeps on growing. So if we want to keep the lights on through the course of the 2020s, we're going to have to subsidize fossil fuels, because they make zero economic sense, or they will make zero economic sense. They're essentially going to become peaking plants without being able to charge peak prices, because batteries will come in and cap the price they can charge. So we have got a real issue in the transition phase, and it will require subsidizing fossil fuels, which is somewhat counterintuitive.
And thinking as an investor, then I've got a few thoughts. One, of course, naturally, I think this is a lot of opportunity in all the new stuff, and it needs a lot of technology. But two, if I'm thinking of investing in energy assets, I've got a real problem, because you're saying that actually prices of energy assets, traditional energy assets, are going to collapse. But you're also saying that there'll be a huge overbuild of renewables, right? And energy from them will be pretty free as well. So what on earth should I do?
As an energy investor, it is extremely difficult. I mean, I think the solar has been a very difficult space to invest in. The Chinese have kind of warped the market to some degree. It's made it very difficult to invest in the technology. I think there's clearly money to be made in the rollout of these new technologies. We're going to be building at an incredible rate. We're going to be ramping up capacity.
Okay.
At an extraordinary rate, and building far more than we're anticipating. So that's going to have a profound, that's going to be an incredible investment opportunity, but you've got to be in the right part of the value chain. I think, batteries and storage are hugely interesting. But what's really interesting are probably the kind of the information platforms that control and balance demand and supply and control and control the energy systems. And they're somewhat local platforms. They're not kind of global platforms in the way the pure information networks are. But that's a super interesting place to invest, I would think.
Okay, so you're kind of saying, well, don't invest in the physical assets, invest in the tech, I think.
Well, in the information technologies, yes, I think that's right. The software and the platforms.
And Jamie, the other question I think there is in reading some of the Rethink X literature, larger companies, established companies, traditional companies have trouble changing. Does that mean the incumbents are gone and there's going to be a new set of companies that arise, or will they be able to shift their business models?
Yeah, and it's the same for countries. It's not just companies. It's incumbents of all flavors, I think, and actually probably analysts as well. But yeah, so yes, I mean, I think it's incredibly difficult to adjust, right? There are all kinds of issues. First of all, there's a kind of mindset issue that you just don't see it coming. You don't see the speed at which it will happen and the scale of the disruption. And I think that's a sort of, that's a problem of not seeing what's happening. But even if you see it, taking action is really difficult because of the management structures, the incentives, all the other kind of incumbency, the baggage of incumbency that businesses who have a really profitable existing business face when they're thinking about disruption. And so there's a horrible history. So there is a clean sheet advantage. It's much easier to come in with entirely fresh mindsets, entirely clean incentives, and build the new than it is to transform the old. But I think people are beginning to become more aware of this, and we're seeing in a number of tactics, investment in some of the disruptive techs. We're seeing people have set up separate units which have far more independence from the kind of mothership and so on. So there are ways in which companies can do this, but in many instances they're just too late, and they still don't get the scale of. I mean, look at what's happening in car manufacturing today, right? I mean, the writing's been on the wall for at least a decade that this is coming, and yet everyone the last 2 or 3 years has started investing huge sums of money, and they're building essentially numbers of different models of electric vehicles, still not understanding actually that once we get vehicle autonomy, it's a whole different market. And I've spoken to a handful of incumbent car companies, at least the boards of them, and I always ask them, what are you going to do? What's your business model when transport's free? And they look at you like you've got two heads, because they just can't comprehend the scale of change. The idea that we go to transport as a service, or we go to electric autonomous robo-taxis, and the cost of that, because the vehicles last 1 million+ miles, are essentially immortal. The cost of transport in that market is so low that we'll see different business models develop that allow transport to be given away in the same way that the information platforms give away the service for free and make money in a host of other ways.
So you see, let's move on to the transportation area, because I think you're saying you're seeing the same rate of change and disruption as with energy. But by the way, as an aside, I think you're just saying also that the big auto companies are paying you to come along and tell them they're bust, and when they don't know what to do about it. Did I get that right?
I'm not talking about the economics of that relationship. No, I mean, not always. We don't. But no, I mean, some of them are interested, right? And I think they have to kind of read our work and at least understand whether we're crazy or not. I think that's probably the mission.
I'm just being provocative, but actually, there's a serious point to it, right? Because you're saying the incumbents are at a disadvantage, and the new entrants have a massive advantage. And in auto, is that the case? Clearly, we see Tesla being very successful, but we also see VW, Volkswagen, right, doing heroic things. Right?
Yeah. So transport's kind of a two-stage disruption, right? Phase one is the EV disruption.
Right.
And even the EV disruption is more disruptive, I think, than people think. In the big difference between an EV and a gasoline car is that it's just got no moving parts really, or far less moving parts. So maintenance costs, but most importantly, vehicle lifetime is just way longer. Right. And so, okay, it doesn't make much of a difference in a personal ownership model, but we expect to see freight, for instance, any high utilization market, freight, taxis, Uber, and so on, be transformed by this, and those markets to grow, because essentially you're spreading the cost over 1 million+ miles instead of over 150,000 miles. So your cost per mile of transport, if you're in if your metric is cost per mile, you're suddenly massively more competitive if you go electric. So those markets we expect to get disrupted very quickly, even in the EV only.
Right, and that's taking your levelized cost of ownership from the energy generation market and putting the same idea, but differently playing out in auto, right?
And that's it. And that's the concept of phase change, that, kind of everything in the system changes, including the metrics you use to understand them.
Right.
And so, the second phase of disruption is when autonomy comes and we move to, a completely different ownership model. We don't own cars, we access them, it's a service, and it's, and it's incredibly low cost. And I think that's, I think that existing car companies can play in the first part of the disruption, perhaps, and they're still scrambling to catch up. But in the second one, it's a totally different game. And I think, vehicle manufacturing becomes commoditized. I mean, it's just, it's because you need far less vehicles, and B, because we just see many more competitors coming. I mean, the barriers to entry, plunge in terms of the hardware. You're seeing Foxconn, for instance, producing vehicles, and they can do it. Brand value will matter far less in that kind of market. So, manufacturing becomes much less interesting. What's much more interesting is information. The information platforms, the autonomous driver, and the platform that connects the user in the vehicle, and maybe goods as well, because these vehicles might serve multiple purposes. And I think we'll see, vehicles entirely redesigned. I mean, what we're seeing now is just, literally just a redesigned gasoline car with a battery. There's a potential to completely redesign these vehicles, and I think that's the disruption that the incumbents are going to find much harder, because how do you compete with basically a software company when you're into very difficult engineering problems?
So Jamie, I can't help pointing out one statistic that I saw in your report. But in the area of transport, I think that you said 95% of passenger miles in the U.S., I think it's by 2030, would be autonomous electric on demand. And that's a huge statement. We're not talking about small changes on the margin. This is major disruption that you're talking about.
Yeah, and that's the disruption that's driven really by economics, right? I mean, certainly in cities, we think transport might well be free, and so that's a major disruption. And of course, you get the vicious cycle for incumbent car manufacturers, right? So we expect the cost of gasoline vehicles and private ownership to go up, and actually, we expect insurance costs to go up, and maybe humans to be banned at some point in terms of 2030s, because it's just far less safe once we get autonomy right. But the big cool in that analysis is when we get vehicle autonomy that's kind of allowed on the roads at the kind of scale we see. And I think, when we did our initial scenario, maybe we were a little aggressive in terms of our assumption. We actually picked 2021 was a year we thought kind of wide scale pilots would start, and then it would scale through the decade. I think we'd push that back if we were to rework our assumptions now. But actually I'm kind of more confident of the end date rather than the start date, because we think, that that actually there's going to be a very short phase of human drivers and autonomous vehicles commingling on our streets. That the benefits of autonomy, once you get them in terms of safety, in terms of travel time and productivity gains, and the economic benefits of moving down the path, they're so big, but you don't get those benefits whilst you have human drivers intermix. So I think what we'll see a kind of city scale, and we expect this to start in China and other parts of the world, where they convert whole cities in one go, iron out the wrinkles and demonstrate the benefits. And then we expect a city like London, to run pilots, and then eventually just, maybe overnight January the 1st one year to switch and exclude human drivers. And so on a city level, it might happen almost immediately. Right, and we expect the same on the trunk roads connecting cities, and so that's a disruption we expect to happen very quickly once it begins, but it's still uncertain, when that start date is.
And are you predicting that it's the guerrilla marketing that all of a sudden a few cars appear and they haven't hit anybody, and then all of a sudden the populace accepts it? Because I think you still have a bias, again, coming back to my political question, where a lot of people think that type of technology is quote unquote dangerous. Although again, reading reports, you point out it's actually much safer. But how do you educate the populace? How do you get them to change? How do you get them to come along to some of your sustainability ideas? Because cost curves aren't enough at the end of the day.
Yeah. So I mean, yeah, it's dangerous to kind of take public opinion surveys today about something that might happen in the future that we know little about, and that's what we tend to do a lot of. We do a survey and we find that people are kind of skeptical of novel proteins or skeptical of autonomous vehicles and so on. And of course, as time unfolds and people become accustomed to them, that kind of changes. I mean, it's the same with cars when they came in to replace horses. There was similar kind of dynamics going on. And I think we can overestimate the barriers to change and the resistance to change. But you're right. I mean, people are uncomfortable and there's a high bar there. We'll have to prove that these things are better. And that's what wide-scale pilots would do. Different regions of the world will have different attitudes, different balance to kind of safety and kind of, economic gains that will allow them to go faster. And I think they'll prove the case. And I think, those countries that are more conservative will just have to catch up, but they'll also have the benefit of the evidence that develops in these other countries. So, I don't see it as insurmountable. But also I expect insurance to play a role in this as well, and liability. That actually, once we have autonomous vehicles, you have to ask ethical questions about whether actually humans should be able to drive at all.
But help me out here, because you said it's quite hard to predict when this tipping point will really start around autonomy, but you're quite confident of the end date. But when is it all done by, do you think?
I mean, I would say 2030 to 2035 is the period we're looking at here. For the end date, that when it happens, it will happen extremely quickly.
Yeah, because that's not very far away. That's
no, it's not. It's not
8 to 13 years. Yeah,
it's not, and there are no real constraints, right? The real constraint is vehicle autonomy, because the scale up of the vehicles, because you have high utilization models. You need a fraction of the vehicles, so there aren't supply side constraints in any meaningful way.
So I'm going to move the conversation along a bit now, Jamie, because you're telling us within the next decade there's going to be massive change with the energy system. There's going to be massive change in the transportation system, which is not just cars; it's just moving everything. But you've also got reports on food production, right? If you're not freaking us out enough already, but maybe can you touch on why these same ways of thinking work when thinking about food, which to many people just feels very different.
Yeah, I mean, again, it sort of starts with a convergence of technology. And so we've got kind of a number of technologies that make up precision biology, right. We have this process that's been developed called precision fermentation, which allows us to produce proteins, any complex organic molecule, by really hacking microbes to produce them as the output. And it's a process that's been around since the early 80s, when we produced human insulin in this way. So we used to get insulin from the pancreas of a pig or a cow, and it took tens of thousands of animals to produce a kilo of insulin. We now do it by essentially fermenting it, brewing it, and it's human insulin, so it's a better product. And so that process has been on an incredible cost curve, right? And so it's from $1 billion or so in 1980 per kilo down to $1 million in 2000, down well below $100 today. And so it's opened up other markets. So we see it, companies producing human collagen in cosmetics, and we're using it to produce, materials, and it's beginning to be found in the food market. So about 90% of cheese in this country is produced using a precision fermented product called chymosin, which is a replacement for rennet, which we used to extract from the stomach of a young cow. And so, we're all eating it already, and it's beginning to open up different markets. But again, it's a phase change. It's a totally different market structure. So, we go from, a model we call a breakdown model, where you grow the whole plant or the animal and you break it down into the things you need. So, the easiest thing to get from a cow is really the meat, right? You carve it off the carcass. The hardest are the single molecules, the whey protein, the collagen, the gelatin, all these things that have to go through a number of processing cycles. So they're more expensive in production costs. This model is the other way up. It's a build-up model. You start with a single molecule or the cell, and you build up to more complex products. And that's kind of the economics of that dictate how the disruption, occurs. So it'll start with the single molecules that, either are used on their own or are kind of ingredients into other products, like the heme that goes into the Impossible Burger, for instance. And over time it will spread. So we'll see, we're beginning to see kind of ice creams and other dairy products disrupt it. And so, that's a disruption that will play out, we think, over a slightly longer timescale. But certainly by 2040, we expect the cost of food production through precision fermentation to be way below the cost of food produced from livestock, and better on pretty much every parameter. Right, better in terms of health benefit, better in terms of environmental impact, better in terms of water use, land use, all kinds of other aspects. So it's a hugely exciting space, and I don't think people quite realize how disruptive these products are. But we're still a few years away from kind of cost parity in most of the food market. But as we get there, we're going to see an incredibly rapid disruption, I think, of a really kind of fundamental market. And it's obviously far bigger than just food. It's all organic material.
But to follow into what you're saying, because I read that Rethink report on also agriculture, it's really profound, some of the other comments that you're making there. I think it was something like 70% of the world's dairy farms would disappear by 2030. As the world goes to more plant-based sources for food and dairy, et cetera. I think already in the U.S., something like 15% of the U.S. milk market is actually plant-based by value today, according to that report. So this is really significant, if you would, change for societies. There are a lot of dairy farmers in the UK. Again, I'm coming back to the political, social questions around what all this means.
Yeah. So you're right. I mean, it is. And these are low margin businesses, right? So dairy farming, really operates on government subsidy. I mean, there's no profit in dairy farming that comes from the kind of economic model. And so, yeah, we'll see it. And a third of the dairy market is kind of whey proteins and so on. A third is kind of ingredients into ice cream and cheese and other products. And a third is kind of in its whole format. So you don't have to disrupt a bottle of milk to disrupt that whole market. The collapse of that industry will happen much, much earlier. And that's a kind of dynamic of disruption, and that's non-linear as well. You need only a small decline in volumes for profits and, the economic case for the industry to be wiped out. So it's absolutely the case. And I think, this is one of the reasons we set up Rethink X. I mean, typically what we've done with technology disruptions is kind of stumbled into them blindly, not see them coming, and kind of cleaned up the mess retrospectively. The communities destroyed, the jobs lost, so on and so forth. And I think, we can see these things coming and we can plan to mitigate them. And actually, this is a really interesting disruption, because normally what happens is you destroy jobs requiring one skill set in a particular area, and you create new ones in another area requiring totally different skill sets. This one's kind of interesting because, as we disrupt livestock farming, whether it's dairy or meat farming, we'll free up huge quantities of land. Right, and we calculate that by 2040, we'll free up an area the size of Australia, China, and the US combined. I mean, it's livestock farming is 75% of farmland, both pasture land and food used to feed animals. So a huge quantity of land that we free up, and we can choose to do other things with that land, right? So we can, it's going to have a massive climate impact, even in a kind of do-nothing scenario. It will act as a carbon sink and sequester carbon. But we could choose to reforest or rewild that land. And so there is an opportunity for these communities and the people involved in farming to become stewards of the land. And this is a low-cost form of carbon sequestration. Right? It's those people, it's obviously in exactly the same location, requiring a very similar skill set, and probably a better job in terms of quality of life. So there are things we can do to mitigate the hardship of disruption, but will require some kind of investment. There's obviously not an economic case alone for that, but that's and that's part of the role of governments that we see is to take those kinds of action.
All these positive technological developments that you're talking about, all this change that's going to happen, is it enough to offset the 1.5 degree temperature rise?
Yeah, so I mean, we published a paper on climate change 3 months ago or so, and we put this all together into these three disruptions because food and agriculture, transportation, and energy represent 90% of current global greenhouse gas emissions. And when we put them through our model, we see a 90% reduction in greenhouse gas emissions by 2040, right? And what's important to bear in mind is it's not just the direct disruption that we've talked about today that you have to consider. It's the kind of second order, third order consequences of disruption. So for instance, something like shipping, sure, there will be a disruption as we learn to use batteries or hydrogen to fuel ship. But the bigger disruption to shipping or freight more generally will come from the need for freight. So, what we're moving towards is a much more distributed, localized production system where the inputs are available locally in abundance. Right, they're much. We need the seed stock of kind of non-organic metals and so on to build out the system. But once we've built it, there's very little flow through it. If you think of a solar, wind, and battery energy system, there's no flow really. These things just run once they're built. Same with the food system. There's far less material going through the system, a much more localized form of production, much more modular. And so, we get to a point where actually the need for shipping gets disrupted because we don't ship coal and oil and grains and livestock products and car parts and so on, and anything like the volumes we do today. And so we'll see a reduction in demand in shipping. So when we model those second order consequences as well as the direct first order disruption, we get to this point of 90% reduction in greenhouse gas emissions. But then the land that is freed up from livestock farming, for instance, just in this do nothing scenario, just leaving it alone, acts to take us to zero. And we can go well below zero if we choose to reforest or rewild. But we're also in a position where we've got a sort of superabundance of clean energy, very low cost clean energy that we could use to sequester carbon as well in energy intensive processes. And there are a number that we've looked at where they become completely economically feasible based on the dynamics of this new energy system. So, we'll have the tools. I think part of the problem with our analysis of climate change is that we take, other than the climate system, certainly the inputs from the economy, we take this simple systems approach. But there's some sort of implicit assumption that our capabilities remain constant out into the future as well. And I think, we don't predict step change technologies, but the idea that by 2040, we're not going to have far greater technological capabilities to deal with these types of problems is just, I would think is insane at some level. So just on the technologies that we can see today, we can see a path to net zero that makes economic sense. It requires no investment. It's what we call our be sensible scenario. And we can get well below zero if we choose to invest.
Oh, so Jamie, you're sounding really optimistic there, but I think you're also saying to people, and I'm going to try to summarize again, that most of us, when we're thinking about the future, look backwards and extrapolate, and that's just becoming fundamentally the wrong way to think about the future. And we need to think much more about the cost curves of technology and about the pace of change. So we need to, if we're investors or planners, we need to think much more strategically rather than looking backwards at trends. Is that a kind of a right summary?
That's right. I kind of think of it as looking under the surface, right? Not looking backwards, but looking at these kind of complex processes that drive change. And if you understand those, at least you can understand the possibility space going forward. Okay.
So if you've got one message for our audience, and the audience, of course, being a mixture of investors, entrepreneurs, etc., what one thing do you want people to take away, right?
Well, I mean, the major message really is that the 2020s and the 2030s will be a period of extraordinary opportunity, but also profound risk. And whether we're investors or we're society trying to deal with some really intractable problems like inequality and climate change and all kinds of other issues that we face today, that we have agency and we have the possibility of solving them. We have the tools at our disposal. But it requires us to see what's possible and to take the right choices. And right now, we don't show many signs of being able to do that.
Oh, a little sting in the tail at the end of it, Jamie. It's as ever a pleasure to talk to you about these things, and keep up Keep up the provocations and the good work.
Well, thank you both. That was fun.
Thank you for joining. That was fantastic.
Thank you for listening to this episode of the Sustainability Talks podcast. To find out more or join as a guest, head over to the ETF Partners website at etfpartners.capital. You can also connect with us on LinkedIn and follow us on Medium at ETF Partners. Until next time, thanks for listening.